The information contained in this podcast is an expression of opinion and does not constitute investment advice. This is the Gold Money Foundation podcast with Dominic Frisby, keeping you up to date with expert opinion on precious metals and the markets.
I'm sitting at the Warwick University Investment Forum, and I just listened to an excellent presentation by author, columnist and investor Jonathan Davis. So Jonathan, welcome to the show. Thanks very much for coming on and doing an interview. The subject of your presentation was what makes a good investor, and then you went on to look at Warren Buffett and Sir Anthony Bolton and John Templeton. So let's start with that. What makes a good investor?
Well, first of all, thank you for inviting me on your show. It's a pleasure to be on the show. Of course, there isn't one simple answer, but I can maybe try and boil it down in a few sentences. I got interested in what makes successful professional investors perform the way they do about 25 years ago. And I spent a long time looking at the careers of people like Buffett and Sir John Templeton and Anthony Bolton. I've written books on that subject. Because it struck me very much that at the time we were told by academics that beating the market is very difficult, which it is, but that there have been a number of exceptional individuals who've managed to not only to beat the market consistently over time, long periods of time, but to do so in some cases with less risk than the market itself, which is something that in theory should not happen. So that was my starting point. I looked at the evidence of some of these great investors to see if there was anything you could actually learn that was useful about what it takes to be a great investor. And a lot of data I could go through, but in essence, what I think I'm saying is that you need a method which is consistent with itself, is not done in exactly the same way as conventional practice would have you do it. And it does require some exceptional human qualities, particularly temperament and character, that not all of us, unfortunately, possess.
Yeah, temperament is the big one because often it's easy to theorize, it's easy to predict which way which direction a market is going to go on to go in, but it's one thing seeing it, another putting it into practice.
It certainly is, and I think it's partly a question of discipline. Making sure that you're asking the right questions at the right time, but then actually having the ability to zone out all the kind of noise, all the emotional reactions you might have to something, and to act precipitously and decisively as a result of that. For example, a good example, perhaps from John Templeton's career, and some people might find this a little uncomfortable, but it's what happened. When the Bhopal disaster happened in India, when remember that gas plant blew up and injured a lot of people. The share price of the company that was responsible for that plant, Union Carbide, tanked. Understandably, there was a kind of instant reaction to that news. No one knew what the liabilities were going to be. No one knew whether it was a good thing or a bad thing. But he was intrigued enough to ask the question of his assistant, well, let's go and look at the numbers of Union Carbide and see whether that will become an investment opportunity. Now, that's not, to be honest, a normal human reaction to news of that kind. Similarly with 9/11 or with the Japanese nuclear disaster this year, you've got to have so focused on your investment discipline that you're prepared to look at things where other people are still having natural emotional reactions to.
I was going to say a comparison to that might be investing in uranium now or in some kind of nuclear plant building company.
Yes, the world is always full of opportunities. One of the things that John Templeton said was, people always ask me, where's the best place to invest? And my answer always is, well, where the news is bad. You've got to look where there's maximum pessimism, and that's where you're going to find the bargains as a matter of definition, because things are cheap for a reason, and they're cheap for a reason because people have got this emotional response to what they've read in the newspapers.
Germany in 1945, one of the great investment opportunities.
Yes, well, there have been a lot of opportunities in history which perhaps you would not have appreciated at the time, unless you were that kind of ice-cold individual, if you like. It has to be you've got to have a temperament of an ice-cool individual, not only to make the decision to look at something like that, but then to actually have the courage to act on it when everybody else is telling you that the world's about to end. Lots of examples through history. The great investors tend to have that ability to do that.
There's a company I know actually called Lydian International, who listed in Canada, run by an Aussie called Tim Coughlin, who I've actually interviewed on this program. And what he does is he's an exploration geologist, and he specializes in going into countries that have recently come out of a war and starting to explore for mineral assets. And he's made a huge gold discovery in one in Kosovo and one in Armenia recently. So that would kind of back up what you're saying.
Absolutely. I mean, another guy who I know quite well is Jim Rogers, who sort of traveled around the world looking for strange things. And in his books, I mean, he talks about some of the things I remember him talking about Peru, about 15 years ago when the terrorists were still blowing up pipelines and things. Yeah. And his point was, and he's also, mentioned Zimbabwe and places like that, or even now Myanmar. He's quite interested in Myanmar because you can see the potential for a dramatic kind of regime change, if you like, which is by definition going to create investment opportunities. But of course, if you don't go and look there, you're not going to find the answer. And I think while most people would say that, I think the key point here is that most people, when they talk about risk, they talk about perceptions of what might go wrong. They talk about political risk. They talk about economic risk. I think what the great investors do is they look at risk in a completely different way, which is they say, what am I being offered by way of a potential reward if things change? And how much money am I actually putting up at risk for that kind of bet? And Buffett's business partner, Charlie Munger, has a very good analogy. He talks about the way that people bet on the horse races in a kind of pari-mutuel system, like the tote. And the point there is that, the tote just tells you what everybody else is betting. The odds are set by the market, if you like, because they just add up all the bets and then they look at the prices and adjust them accordingly. Now, what you should do as a punter on the horses, what the most successful punters do, is you wait for the very good opportunity where the risk reward is very much in your favor. And that is the Buffett approach. I'm not going to do anything. I don't have to invest in anything. I'm not going to do anything until I can see an opportunity where the risk reward ratio is very much in my favor. And if that happens to be in Peru, which it probably won't be in his case, but if it happens to be in Peru, so be it. It's all a question of odds. What am I putting at risk and what am I going to get back?
And which requires, in some cases, a lot of patience. You've got to be prepared to sit in cash for long periods, I guess.
Yes, and I think the other answer to that is you have to not be an institutional investor, basically, where you've got people pressing, looking at your performance on a weekly, monthly, quarterly, yearly basis, looking at how far you've deviated from some benchmark or index, or who have some kind of concern about the overall risk level of the firm. You can't do it that way. It doesn't work that way because that's not how the world works. If you really want to beat the market, you've got to act in an unconstrained way and be free to do that. And I think the genius of people like Buffett and Templeton, and to a lesser extent, people like Anthony Bolton, is they manage to create an environment which they can do what their instincts and what their whole talent base, their whole skill base allows them to do better than anybody else. And that really is the secret. Create the vehicle that will allow you to do what you're really, really good at.
Yeah, I mean, let's talk about some of the methods. Let's talk about Anthony Bolton for a moment. I mean, he's very fond of charts, as we know, and I'm crazy about charts, but for him to have looked at charts at the time he was looking at charts, when that was still considered extremely unconventional.
Yes, that's true. I think there has to be said, I mean, he works for Fidelity. He works for Fidelity. And Fidelity, Ned Johnson in the States has always had, at Fidelity's head office, they always have this big chart room where he's always been interested in charts. And so if you are a fund manager at Fidelity, you can go into their chart room and you can see a chart of everything. It's all pinned up on the wall and you can look at that. So I think that was one reason why he did look at charts. But the second was that actually it worked for him. It wasn't the thing that made the decisions for him, but it very much helped him in terms of timing his decision, his buy and selling decisions, because they show the pattern of where the market is, if you like. And he used that very effectively to time his buying and selling decisions.
Now, you said there it worked for him. That was another interesting thing about your talk, is there's no one method that works. You have to find a method that works for you. Now, we were talking about risk, and I personally invest a great deal in speculative junior mining companies. And I think in my case, the biggest risk is not necessarily political risk or geological risk. In my case, the biggest risk, excuse my language, is bullshitters. And, there's a lot of them in mining, and also incompetence on behalf of management. And so, my kind of filters, if you like, have to be most alert to that. But going back to what I was saying about you have to find what works for you, it was interesting to see that how Templeton's performance suddenly improved, or not suddenly, but noticeably improved as soon as he moved to a beach in the Bahamas.
Yes, that's true. That's a fascinating thing about his career, I think. He ran this mutual fund for about 18 years before he moved to the Bahamas. He'd retired, basically. He was in his 60s, sold his other business, couldn't sell his one remaining fund, but he wanted to go and live in the Bahamas with his wife and enjoy his retirement. And so what he did was he started running this fund, this mutual fund, from the beach in the Bahamas. He would go out every morning for an hour or 2 hours with a bunch of newspapers, and which were, by the way, 24 hours out of date, and a bunch of analyst reports. And he would sit there and he'd read through looking for good stock ideas. He didn't have any brokers ringing him up. He didn't have any instant news from the front line of the market, what was going up, what was going down.
No Vancouver promoters selling him stuff.
No Vancouver promoters selling him stuff, absolutely not. Pure, simple, long-term analysis of stocks, looking for things that were cheap. That was all he did. He didn't have any additional advantage that anybody else had, but he actually could concentrate in isolation from all the noise that we know makes up the daily grind, if you like, of the markets. And his performance improved dramatically. He started beating the market by 6% a year and kept it up for about 20 years without doing more than 2 hours a day, which I think is a pretty interesting commentary on what most other fund managers do.
Yeah, the futures trader Mark Shipman has a similar method. He'll only look at the markets on a Saturday morning when they're shut, so as to filter out the noise.
Yeah, well, that's very sensible. That's very sensible, because after all, what is investing? What is it? It's basically buying cheap and selling high. We all know that's the basis of investment. So what you should do is, and what I think people like Templeton did, they concentrate very much on that single question. Is this thing cheap on the basis that I use to analyze these things? Buffett is exactly the same. He says, wait for the fat pitch. There will come things. If you do nothing at all, there will come things, and you're not worried about the fact that somebody else has done better this year, or somebody else has made, 200% out of investing in some exotic thing. Just wait for the opportunity when the market has got it wrong, and where you can buy something for a fraction of its value. And if you do that and hold it for long enough, you will make money. You may have to hold it for 5 years, but hey, that's not so bad.
Very good. Now, just changing the subject slightly, Jonathan, as we wrap this up. I want to just talk about the kind of environment that we're in. You posted a few charts, a few long-term charts of the government bond markets and the commodities market. You think this is a pretty tough environment in which to make money. So why don't we discuss the current financial environment and what you see as opportunities at the moment?
Okay. Well, I'm old enough to have been following the markets now for quite a long time, unfortunately, something between 30 and 40 years, I suppose. And I started out in the 1970s when things were very, very bad. And in my lifetime, I've seen the greatest bull market of the 20th century, followed by a period of tracking sideways. And now we're entering into what I think is quite dangerous territory. And there are a number of reasons for that. But essentially, I think, as we all know, the Western world, the developed world, has got itself into a terrible pickle. And worse than that, it did it with its eyes open. I don't think you can absolve the central bankers of our time or the governments of our time from blame for the mess we're in, which is that we have got ourselves in a position where we have overborrowed to a massive extent, and we're trying to fix the problem by making the problem worse. And that is a very dangerous environment for any investor. Added to which, we've had a 30-year bull market in bonds. If you bought a government bond 30 years ago and done nothing else, you would have actually beaten the equity market and made a very handsome return over that period. All because we've been living through a period of disinflation, of falling interest rates, for which there are many reasons. We can talk about the Chinese emergence of the emerging economies and so on. Lots of reasons for that, technological change as well, and government policy. At the beginning, very benign, now the opposite of benign. We are trying to put our finger in the dike and stop what we have to do, which is to face up to the fact that we have overborrowed, and a lot of our economies in the West are in a terrible mess. And that is not going to be an easy environment in which to make money.
Oh dear, very worrying. Final comment. I wondered if you noticed this. We're at Warwick University. There must have been, 150, 200 students in the audience, looking for investment ideas and looking to find out about, making their way in the world of investments. Warwick, in the Midlands, in the heart of England, I would say 65% of that audience were Asian, another 10 or 15% Eastern European, and in terms of kind of native English speakers, less than 20%. I mean, in many ways that's wonderful, but if you think of demographics being destiny, boy is destiny or financial progress headed east.
Yes, I think that's true, and I think I don't think that's a bad thing. I think that's just part of the cycle of history. We had a very good run for a long time, and now these guys are having a very good run. I think also, there's nothing wrong with us as a country. Education has become one of our main export industries, and we should encourage that. I think we benefit from it in the long run. Obviously, if we were squeezing out our own students from actually getting a decent education, that would be worrying.
But we weren't squeezing out our there were empty seats there. There was plenty more room for locals to come. They just chose not to.
My main concern about the audience was that how many of them wanted to go into the investment banking industry. I think the investment banking industry is basically shot. It will survive, but its business model is pretty uncertain at the best of times. And I don't see going forward. I think that banking of all kinds is basically a very simple business. You buy money, you borrow money at one rate and lend it out at another rate, and you make a profit on the difference. But in an environment where we're not going to get falling interest rates for much longer, it's going to become much harder to be a banker. And investment bankers who take half the profits that their firms make for things that they're on the whole, by and large, not always, but by and large, they haven't actually earned. I don't see that's a sustainable business model of the future. And I rather wish that all these students would be going into other things where they're more likely in 20 years' time to look back and say, my God, I made a good decision not to go into investment banking, but I went into manufacturing or into agriculture or something like that instead.
Final thing I wanted to touch on. You said that Buffett, Templeton and Bolton had three qualities, and one of the third quality that they all had that one should look for in someone who's in managing your money was integrity. Why don't we just talk about that for a second as we close?
That's very, very important. In fact, that's the most important thing I think about investment. Looking after other people's money, whether you're managing it, advising on it, or whatever you're doing, it is, you can say it's a service industry. It's certainly not a product industry, which it has become in the last 20 years. And it is a fiduciary responsibility. You have to have responsibility for looking after the best interests of your clients. And I think that some of that has been lost in the last 20 years. We've entered a world where everything was product-driven, sales-driven, and the client has actually slipped down the list of what is most important for many firms. And I think as a consequence of that, why I say integrity is so important is that you obviously want people who are talented, looking after your money. You obviously want people who work hard and do their homework. But most of all, if you haven't got the third quality, which is integrity, in other words, the idea that they will look after, put your interests first, not their own, then you're going to have problems because that combination is lethal. You've got someone who's very clever, very hardworking, but actually working for himself rather than for you. That is a very dangerous combination. And I think the sooner we get rid of that particular model, the better we'll all be.
Very good. Well, Jonathan, thank you very much. You've got a new book coming out. Why don't you give that a quick plug?
Well, I have written a book about John Templeton. I've co-written it actually with a fund manager, a very good fund manager called Sandy Nairn, who worked for John Templeton for 10 years in the 1990s, who now runs his own successful business in Edinburgh. And what we've done is we've gone back and we looked at, there've been lots of books about Templeton. Some of them, I have to say, are sort of slightly verging on hagiography. We've gone back as professional investors, looked at what his track record was, looked at his methods, and tried to explain why they actually work so well. I can't say that we've cracked all the answers, but I think we've got some of them, and it's been a very interesting experience. It's 100th anniversary of his birth in this year, which is why the book is coming out this year. And we're hoping that some people will hark back to these rather old-fashioned virtues of hard work, thrift, and integrity.
Very good. And what's it called?
It's called Templeton's Way with Money, and it's being published by Wiley's in the States in April.
Okay, and do you have a website, Jonathan?
I do. My website is called independent-investor.com. And on there, you'll find all sorts of things that I've written in the past. I've been writing for a long time, and so you can even find some columns from the 1990s, which I think still bear reading, but not all of them, perhaps.
Well, your hit rate is about to go up massively as a result of appearing on this show.
I'm sure.
Jonathan Davis, thank you very much.
Thank you.
Subscribe to the Gold Money newsletter at www.goldmoney.com to receive email updates on new articles, videos, and iTunes podcasts from our Gold Research section.